My point is that the sophisticated methods shouldn't be, in the perfect world, shouldn't be exclusively available to just folks at prop trading firms. Rich people getting richer. Like I would hope we would be able to deliver those to the average investor.
This episode of Ken's Nearest Neighbors is brought to you by Z by HP, HP's high compute, workstation grade line of products and solutions. In today's video, I had the pleasure of interviewing Vivek Viswanathan. He's a portfolio manager of the Rayliant Quantamental China Equity ETF and is the global head of research and portfolio management at Rayliant Global Advisors. He has a Ph.D. in finance from UCI, a master's in financial engineering from UCLA, and a bachelor's in economics from the University of Chicago. He's worked 15 years in quantitative investment management. In this episode, we talk about how data is used by institutional investors. We also compare institutional investors from individual consumers using something like Robinhood, for example. Really fascinating conversation, and I'm glad that you all can be a part of it. Vivek, thank you so much for coming on the podcast. You reached out to me about talking about the intersection of data science and investment management. And that is something I absolutely wanted to have on the podcast, something I'm personally curious about. And I've heard a lot of, insight surrounding that on different channels, YouTube, Twitter, whatever that might be, especially with the excitement of GameStop and crypto and all the things that are going crazy right now. I think your insight on just this space in general is going to be tremendously interesting. So thank you again for coming in to chat with me.
Awesome. Thank you. Thank you so much for this opportunity. One thing I need to get out of the way is all views in this conversation are my own and don't represent the company I work for or any other organization. And nothing I say constitutes investment advice or a recommendation to buy or sell any security.
Awesome. So I think that's an important thing to get out of the way. You know, we're talking as two people trying to just learn and get an understanding of this playing field. I actually, absolutely, even in my work for podcasts or wherever it is, I will never tell you to explicitly do anything. I'll say that, hey, from my experience, this has helped.
Yeah.
But it's a lot of burden for me to say, hey, you should do this thing. Look, things like building a portfolio, working on projects, I highly recommend you do, but that's not something that involves directly your financial situation. And I always have some drawbacks around making any recommendations with money in general.
Absolutely.
So I want to get started and learn more about your background. So when was it that you first got introduced to data and the value associated with it? Was it one of these snap aha moments where you're like, wow, this is really cool? Or was it a slow progression that intermixed with your broader career?
Yeah, so I started in quantitative investing about 15 years ago. So what was involved there was investigating particular signals, basically feature engineering. But instead of putting it into a sophisticated model, what you would do is you would sort stocks on that particular feature, and you would buy high values and either short or avoid low values, right? So if you shorted them, you'd call that a factor. It's a long short factor. And if you just kept a long only portfolio, you only bought stocks or whatever the asset is, you would call that smart beta. So features in this context might be return on equity. It might be earnings to price. It might be book to market. It might be momentum. These are just the sorts of features that tend to predict stock returns. So I spent a good part of my career and even life working on that aspect, feature engineering and very heuristic portfolio construction. It was only a few years back, and it was actually after I had moved firms. So I'd spent about 9+ years at a firm that did smart beta factor investing. And we actually spun off the Asia arm of that firm and started the firm that I'm currently at, Rayliant Global Advisors. And we started with a factor approach at first, but then moved into the more sophisticated machine learning approach, optimization approach. And it definitely wasn't an aha moment, but what happened was we realized that there were many more features than one could reasonably build heuristic portfolios on. That is, we had something like 100 plus features that seemed to predict return at least somewhat well. And the question is, what do you do with that? How do you heuristically build a portfolio from that? Now, if one is utilizing machine learning, it's actually quite obvious what you do. You use those as features in a predictive model and you predict return. And then you just have one thing there. You have expected return and you can build an optimal portfolio from that. A mean variance optimal, mean tracking error optimal, whatever your risk measure is, you can build an optimal portfolio from that. And a couple years back, I had been watching various machine, or I should say data science YouTube channels, yours included, and reading various papers on data science and machine learning. And I realized that this is at least worth investigating. Now, there wasn't necessarily an aha moment, but there was a moment where we saw the results of the model, and we realized that this completely dominated what we were doing before, and we realized that we needed to migrate over. Though that was quite an investment of time to even realize, right? So you see a model and a method out there that's completely different from what you're applying right now. You have to invest a lot of effort to test it, and so it took us a few months to get to a stage where we said, look, this is better. We need to utilize this model. So not quite an aha moment, but when we saw those results, it was pretty clear what we had to do.
That's very interesting. You know, something that stuck out for me during what you just said there was how you described features. So I think features in finance are a little bit different than they might be in marketing or another domain. They're already transformed for the most part into some form of like KPI, a key performance indicator, right? So you have like price earnings ratio, which is a ratio of two other things. You have like whatever other metrics that are out there that I can't think of off the top of my head. But you're working with already generated like in theory, like very small models that you're analyzing already. And I actually think that in a lot of professions, those like KPIs or those other ratios of different things, they can get in the way of machine learning. It's like, oh, we have these already, they're reliable. What, you know, why would we go any further? And I see that a lot in sports. Sports, they're just as prevalent as they are in finance. In baseball, you have batting average, you have you know, you have wins above replacement, you have a bunch of these different things, which are relevant in sports analytics. But to go from those to the more sophisticated machine learning models, it is a little bit of a jump, and it's a completely different way of thinking. You kind of have to deconstruct the original tools that you're using, and you build something not completely different, but with more of the foundational building blocks.
Yes, that's a great point. And we've actually tested this briefly in another context where we start with the ingredients instead of the kind of full-fledged feature, right? So instead of earnings to price and return on equity and so on and so forth, you would just go through a financial statement and scale everything by assets. And then you would take the differences of all the variables. And you would say, look, I don't know whether this is going to predict return or not, but my model will figure it out. That works okay. And so you can actually take an approach that lives in the deconstructed space and you do fine. And there actually have been papers looking at whether you can elucidate useful features using machine learning. So there again, you start with the base building blocks of, let's say, return every day for the past 365 days, volume, so on and so forth. And then you just let the model infer what is relevant for predicting return. And then let's say you're using a neural network. You could then look at the last layer before predicting return and view those as relevant features, higher level features in terms of predicting return. Now, of course, those are much more complex and difficult to interpret, but um, they have that same flavor. That is, they're higher order from the base level data and are individually predictive of return.
Very cool. Very cool. So I think it would help to set the stage if we talk a little bit more about more broadly what finance is and means. So
Sure.
what is the difference between investment management, between a hedge fund, between a prop trading firm, between a just kind of trade for fun type of person like myself, a mutual fund even? What, just setting some boundary lines there, I think will help us move the conversation forward and give people a bit more better understanding of how data might be used differently across these different subcategories and domains.
Yeah, even in finance as a whole, there are different parts of the business, like they're banks, they're they're investment banks, commercial banks, so on and so forth, and those have that's its own game, right? There are definitely things that are domains in which one can apply machine learning. I don't know anything about that. All I know is investment management. And within investment management, like you said, there are mutual funds where you're generally just buying securities, whether it's bonds or stocks. And then you'll have a hedge fund that allows you to do other things. It'll allow you to invest in more complex derivatives like options, like swaps. Although technically, even in a 40 Act mutual fund, you can do both of those things. But let's ignore that detail for now. And hedge funds are generally charging more and doing more complex things, but they're still managing other people's money. Prop trading firms are managing the founder's money generally. So somebody got very rich and they want to make even more money by managing their own money. And what I find interesting about these differences between prop trading firms, hedge funds, and mutual funds is how they implement. So prop trading firms, and there's quite a bit of variety even among prop trading firms, but they are often implementing very sophisticated algorithms, trading on a very short term, and they generally do well. And we might think, okay, why is that, right? But why are these guys doing well? And I should also mention, this is also a critical piece of information. Mutual funds and hedge funds tend not to do that well, right? So the average mutual fund in the U.S. underperforms. And in particular, 90% of U.S. large cap mutual funds underperform their benchmarks. So that's a pretty bad set of performance.
Is their benchmarks just the market return?
Yeah. So it'll be like the S&P 500 or the Russell 1000 or something like that. So something that you can very easily buy and earn that return. So the question is, why are you paying these folks to underperform on average? Not only that, their performance is not persistent. So you might think, oh, just invest in the guys who have historically performed well. But that is not a good recipe, it turns out. Those guys will tend to perform just like average after that. So compare that to the prop trading firms. And it's hard to get data on prop trading firms because they don't need to release private, but they, from all appearances, seem to be doing well, right? So you might look at the Renaissance Medallion Fund. You might look at all these market makers, effectively like Citadel and Jane Street, DRW Trading, that are just sort of managing their internal capital and earning excess returns. So why don't the mutual funds just do something more sophisticated? And the reason why, it's not entirely clear, but I mean there are a few reasons why. But one is money needs to go in and out of the mutual fund easily, which for a prop trading firm they don't need to worry about that stuff. But there are other kind of more institutional reasons. one is that the fees are lower in a mutual fund. So if you were really skilled, you probably wouldn't go work at a mutual fund. You'd go work at a prop trading firm. Secondly, you generally have to explain to a client why something is working. So it'll often be the case, especially at an institution, or even to some extent an advisor, high net worth. You have to go to them and say, this is why we're performing the way we are. At a prop trading firm, you don't need to explain it to anyone. You just need to make things that make money. So the incentives are different there. And with a mutual fund, on average, you're making money by managing more assets, not by performing well. Now, of course, it is the case that performing well will tend to net you more assets, but it's not what is necessary alone, right? You need other things as well. You need a marketing engine, you need salespeople, so on and so forth. So the incentives aren't fully aligned there in the way that it is with a prop trading firm, where it's literally somebody with their money saying, I want to make as much money as possible. What do I do? Now, the reason why I think that's relevant, that prop trading firms do one thing and mutual funds do another thing, is we want to do what the prop trading firms are doing effectively, right? You want to be doing the sophisticated thing that makes money. And ideally, I want to live in a world where we're getting that to people, where the average investor gets to invest in something that is actually quite sophisticated and works well. Now, of course, over time, on average, the full set of market participants can't outperform the market. They have to exactly equal the market return. So the markets will just get more efficient over time. So it's not as if we can all earn excess returns on the market. That's not what I'm getting at. But my point is that the sophisticated methods shouldn't be, in the perfect world, shouldn't be exclusively available to just folks at prop trading firms. Rich people getting richer. Like I would hope we would be able to deliver those to the average investor.
Yeah, and something that we talked about a little bit offline is how the average investor, the person or the company that invests in mutual funds, is not necessarily someone who's looking to make a tremendous return. They're maybe investing a pension, or they're doing something like that. It's a yes. large business to business, engagement, and being able to explain why this pension is going to still be around after 3 years, or explain what happens to it, is really interesting. And there's that communication issue that if it's a black box, if it's too opaque, you're not going to be making these larger business deals. And if the volume is the money is being made from working with and accumulating assets, that's a really important part of that puzzle, right?
Yeah, that's a great point. And we should keep in mind that some black boxes have blown up, right? So long-term capital management is probably the most famous example. That was in 1997. I think it's 97, 98, something like that. But it was these extremely smart, well-known people in the field who started a hedge fund. It was a quantitative hedge fund. They were taking tremendous leverage, and they basically lost all their money. Now imagine if a pension, somebody's pension fund were invested in there, that a endowment were invested in that, that would be a disaster, right? So I absolutely agree that when it comes to people's life savings, where if they lose it, they're in serious trouble, investing in a black box is risky, not just because of the risks that are apparent from the model's output from a back test, but because of model risk itself, that there's something fundamental about the model that is missing, and that it can blow up. So absolutely, I 100% agree. And indeed, if actually, me personally, I generally, almost all my money is in ETFs. So I'm, capitalization weighted ETFs. That is where most of my money sits. So doing these sort of sophisticated things, doing these crazier strategies. That's not something I would do with even all of my own money. I want to be diversified there, right? And indeed, I would recommend other folks do the same.
This episode of Ken's Nearest Neighbors is brought to you by Z by HP. HP's high compute, workstation grade line of products and solutions. Z is specifically made for high performance data science solutions, and I personally use the ZBook Studio and the Z4 workstation. I really love that the Z line can come standard with Linux, and they also can be configured with the data science software stack. With the software stack, you can get right into the work of doing data science on day one without the overhead of having to completely reconfigure your new machine. Now back to our show. So one question that I have is on the complete opposite side of that. How do these mutual funds get away with just underperforming all the time? How do you still have customers if you're always doing that? Is there something with the explainability of the market or the long time horizons? What does that look like?
Yeah, there are a couple of things there. So if you have several thousand mutual funds, some of them will outperform and some of them will underperform. And the ones that, and let's say performance is completely random, which it roughly is. The ones that underperform over extended periods of time will slowly drop out. And then those folks will then go start new mutual funds. So if you look at the pool of mutual funds that is existing at any given time, you'll see decent performance on average, right? And that's because they have performed well historically. And the ones that didn't perform well went under. Then, of course, the ones that performed well, because performance is indeed roughly random, will then start on average underperforming. And so you'll constantly see this churn of mutual funds where the underperforming ones slowly disappear, and then the people that were in those mutual funds will then go and start new funds, and pulling a random draw there. So that's a significant part of it. The second part of it is fund managers are good at convincing people that it is rational to stay in their product, right? So let's say you're a fund manager and you underperform for 2 years, and the client comes to you and says, look, you're underperforming. Why should I keep money with you? What you'll argue as a fund manager is, look, the market's wrong. I'm not wrong. The market's wrong. You just need to be patient and wait it out. You're a patient person. You don't want to just pull money out right now while this thing is ready to take off, so on and so forth. Right. So that's sort of what you see. Now, I don't actually think that most people in the industry are crooks per se. I think they genuinely believe that they're skilled. It's just hard to admit that you're not skilled, right? That's a difficult thing to come to terms with emotionally, intellectually. Everyone talks about the imposter syndrome, right? But that is not nearly as prevalent as people just overestimating their abilities. That's the on average, thing that on average exists, and that's extremely prevalent in investment management. I don't think some people, of course, actually are crooks. They know they are terrible and they're just pitching nonsense to people. But most people genuinely believe, they're like, look, it'll turn around. I know what I'm doing.
Well, it's funny. I forget what the phenomenon is called, but the opposite. Yeah, the Dunning-Kruger effect, exactly, is that people who are less informed think they know more than the people that are like very well informed and very knowledgeable about a topic. And I use that conversation around imposter syndrome all the time, is if you're like doubting yourself, it probably means you're like going down the right track because you're pushing yourself and you're getting out of your comfort zone. Absolutely. Well, it's interesting. I felt that same feeling every time I've played, fantasy sports or something like that. It's like, wow, I'm not winning, but it can't be me. Like, my analysis is bad. Is the randomness in the scenario that and then after a bunch of times you're like, okay, maybe it's me. Or every time I
actually really love Kaggle for that reason. Whenever I feel like overly proud, let's say, just join a Kaggle competition and see how your first few models do. It's generally not pretty.
Yeah, I did
Yeah.
this one for the NCAA tournament, and I mean, I was in the top half of the field, but at the
Yeah.
same time, like, this is what I do for a living. I mean, I obviously
Yeah.
didn't get to invest as much time as I possibly could on it. And
No,
I didn't get to back test the models, but still,
right.
it's like, hey,
Yeah.
this is a competitive landscape.
Yeah, and I felt the same way doing the Jane Street competition. I didn't score particularly well there. I scored great on the public leaderboard, but the private leaderboard was just just a massacre. But it's great for that reason alone. I mean, there are many reasons that it's Kaggle is a useful thing to interact with, but one particularly compelling reason is it shows that there are very, very skilled folks out there, and you're competing against some clever folks.
Absolutely. So, shifting gears a little bit, I want to get your sentiment, your feeling on just the consumer finance push, where the individual investors are kind of making maybe fairly risky trades, or
Yeah,
they're getting really into it, maybe with some
yeah,
extra stimulus check money, whatever that might be.
yeah.
To me, that's a pretty fascinating, like, psychology and economic, not a problem, but it's a landscape there. And I'd love your input on that from someone who's on the more institutional side.
Yeah. So on average, I think it's best for people to just go into capitalization, which is like very cheap. Go for the cheapest thing you can possibly find. Capitalization weighted ETFs. I think what happened with the GameStop is fantastic. I really love seeing the the little guy win. But it's not as if hedge funds. I talked about mutual funds underperforming on average. It's a little bit harder to measure with hedge funds because again, their performance isn't fully public. There's voluntary disclosures, so on and so forth. But it looks like they, on average, underperform after accounting for market risk, and interest rate risk. So you need a few variables in there to demonstrate their performance, or to explain their performance. But you do indeed see underperformance there. So it's not like cutting, where beating the hedge funds is some amazing feat, so to speak. I guess they're on average losing anyway. But that's neither here nor there. I think with respect to the rise of retail trading, we'll need to look at the empirical data. But historically, retail trading has underperformed, right? So retail traders have underperformed mutual funds, which have in turn underperformed the market. So if we slip back into that modality, we're going backwards, because every time a retail trader is trading, they're trading against, on average, someone who is more sophisticated, whether that's some algorithm or just some hedge fund manager or whatever it happens to be. So it's something I wouldn't recommend. Now, if somebody's doing it with some small amount of money that they get utility out of making these bets, they get enjoyment out of the potential to make a killing, having some incredible right tail event. That is something that one can enjoy in its own right, and that's entertainment. I dig it. Do what you got to do there. But I think it's crazy to expect that on average, a retail investor will beat the market. Just empirically, that hasn't been the case historically. That it would change suddenly would be incredible to me. And it would be unintuitive, right? Those are the folks that you would least expect for that to happen. So what happened with GameStop, still very cool, very it was exciting to see, right, that whole thing play out. But just on average, it's not going to be a good bet.
Interesting. And so, there are a couple of factors at play there that I'm fascinated with. So one is consumer sentiment, right? So stocks are driven by interest and purchasing in them, like the
Yeah.
pricing.
Yep.
And
Supply and demand right there, right?
yeah, and I mean, I wouldn't say it's illegal market manipulation per se, but if you do have movements like what happened, um, and where everyone for the most part can ride the wave, that's a very interesting, again, phenomenon that hasn't really been pressed. I mean, you've seen that from the larger forces where hedge funds are effectively manipulating the market in certain ways, but you've never seen that from a consumer perspective. And does that
Yeah.
change how investments are made going forward?
It's a good question. I don't think it's sufficiently big at the moment to affect, let's say, quant strategies, though you could use sentiment algorithms to, looking at Wall Street bets and predicting returns that way. Would it affect the average investor? I don't believe so. I think the people it affects the most are short hedge funds. So if you take a concentrated short bet, now you need to worry about Wall Street bets seeing there's a very high short interest on this stock. Let's buy it up and generate a short squeeze. I think that is something to worry about for those folks. But those types of hedge funds are rare. Normally, you have long short hedge funds or hedge funds trading derivatives. You sometimes even have long only hedge funds, but pure short hedge funds, they're not. Those aren't the main bread and butter of hedge funds.
Interesting. And so, I guess looking at through my own lens as a consumer investor, what's the correct term for it? A retail investor?
Retail investor, yes.
Do you think it's possible, for example, me to use data science, me to use algorithms to create an effective advantage? Or is it something that, these models are most valuable at scale, and that's where they're gonna create the most, if any, returns? So, that's something I saw in daily fantasy sports where if I wasn't investing $10,000 a week in playing these games, I couldn't expect a reasonable return over time. And that is not something I was prepared to do.
Yeah, I think it is likely the case. And I haven't investigated these particular strategies because I am at scale. And so I need, not me personally, but
Your work,
yeah. And so it doesn't necessarily make sense for me personally to investigate this aspect. But it is likely the case that there are horizons of prediction or stocks that are sufficiently small where one could apply data science methods and not need to get to scale for it to be sensible. So if you're a market maker, you need to be at scale for you to make money. And those guys are doing high frequency prediction and high frequency trades, and they generally make quite a bit of money doing it. If you're a small trader, I imagine you can focus on smaller cap stocks and build predictive algorithms to trade. Yes, yeah, I absolutely because that's a niche that's likely untapped by the bigger firms. We're always thinking about liquidity. We're not even a particularly huge firm, but we need to. We run into liquidity issues with some trades. If you're few million or less, you can trade in these stocks, many of them high expected return stocks that we want to buy, but we just can't, right? Our algorithm saying buy this thing, and there's not enough liquidity there. Well, if you're trading with sufficiently small funds, there's great liquidity there, right? So I think it's possible. I haven't done it myself, so don't. I want to caveat that I don't have some strong empirical evidence to say yes, go do it, you'll make money. But it seems exceedingly sensible that is true.
Interesting. Well, so that's hopefully perpetuated by your ability to buy shares of individual, like partial shares of individual stocks on some platforms now. I think that that's an interesting
Yes.
idea
Yeah.
that
Yeah.
would make it a lot more feasible to start with a smaller portfolio here. Obviously, I think there are probably fees associated with buying not full shares, and companies are taking a little bit of margin on either end. But that is something that, now that you bring it up, does make this seem a lot more feasible on my end. I'm not sure what trading costs might be, and you have some like time sensitivity issues, so you'll probably have to maybe not be trading on an hourly basis, but on a couple day time frame or month windows or whatever you're using. But that is very interesting to think about, is that, hey, because of advancements in technology relating to how stocks are traded and the fractions of them, that can facilitate the retail investor who is leveraging more advanced tools for them to have more options in this space. And so
Yes.
I really like that. Obviously, I've fooled around with those types of models and have not had any success. So I'm very interested in always hearing from the community about what types of things you're working on, because although, again, we're not saying that this will, there's no guarantee of success in this space at all.
Yeah.
If you're comfortable losing some money, I think it's definitely worth trying. That's a very
Yeah.
cool story to tell, especially if you want to work in the space, that you were able to build something like that and have some success over time with it.
Absolutely. And this is a different space relative to a lot of machine learning applications in the sense that it's adversarial. I suppose sports betting is like that as well. That is the better the better the technology gets, the better that other people get, the worse you're doing, right? So if you have a translation algorithm, for example, it's not like somebody else having a good translation algorithm makes your translation algorithm worse. But if someone is better at predicting stock returns, they will capture all the alpha that you're trying to capture, all the returns that you're trying to capture. And your model will then perform worse. So does sports betting work like that? I actually don't know. I don't know enough about sports betting where.
Well, so I think sports betting is a pretty fascinating market to compare because it is a closed circuit. Like upside and downside for the most part are capped. So like, there's going to be a certain amount of winners and a certain amount of losers. In the stock market, you can in theory have unlimited winners or unlimited losers based on the direction it goes. Like there's no upper or lower limit.
Yeah, that's a good point. Though I would say, as far as beating the market, you can't have unlimited winners and losers, right? So it definitely is the case.
Individual
Right.
security,
right?
Yeah.
No, you're absolutely right. I think because it is the case that there are the market on average goes up, and you can't the average investor cannot beat the market, right? Certainly, they will match the market at cost, or before cost, but after cost, they'll underperform on average. Because of that, people recommend investors just to buy the market, right? Because just on average, you have to underperform, right? Just mechanically after cost, you will be underperforming the market. It's only by being either more skilled or lucky that you would outperform. But it sounds like
doing something legal, right?
Right. Well, we can throw that under skilled, right? That's its own skill, I suppose. But and then I guess you need to rely on the luck of not getting caught. So right, I do see both the similarities and the difference there, right? So on average, you want to be invested in the market, whereas on average, you don't want to be doing sports betting, right? It's not like, you want to go into blindly bet on everything, right? That just doesn't make any sense in context of that. Whereas when it comes to equities, blindly betting on everything, that is buying a cap weighted ETF, is a sensible strategy, right? You're just participating in the economic growth.
In theory, make money if you bet on the market over time, whereas you will always lose money if you're the average sports bettor over time.
Yes, absolutely.
which, you know, again, like if you're really good at sports betting, I think that probably you'll make better returns than you would being very good at the stock market, maybe not very good at trading, maybe not elite, just because the feature space is so much more defined, and you're able, but those advantages erode over time. Like you might not be allowed to bet with certain sports books anymore or whatever that might be.
Yeah.
And so there's a lot more risk associated with that as well. So very interesting, similar in different spaces.
I've got a question about that. Sorry, I know you're supposed to be asking me the questions.
No, I love it.
Okay, so you remember how I mentioned that mutual funds don't show persistent performance, at least in equities. So if you're an outperforming mutual fund, that doesn't tell you anything about your future performance. Is that true in sports betting, or is there persistence there? That is, do people who tend to win at sports betting tend to do well in subsequent bets?
Yes,
okay,
because it's an information game. Well, I mean, not that trading is not an information game, but the majority of money that's won in sports betting is on prop bets. So like the consistent people who are winning a lot, and this isn't my expertise. I just watched some documentaries on this.
Okay, got it.
I'm probably more familiar with sports betting than the average person, but you know, their advantage comes from knowing what color the Gatorade is going to be that's poured on someone, right? And they get that from their funnel of information. Those are significantly higher percentage bets that most people are making because they're throwaways. They do make money on the games consistently. You can leverage models, whatever it might be, but there's still a tremendous amount of randomness in sports. And so I'd say that those people probably consistently outperform the average sports bettor in those other domains. But if they're really focused on making money, they're taking the weird bets, the arbitrage opportunities within the markets, and they're looking across a bunch of different sports books, because different sports books have different odds for different things based on the way the money's flowing in. So the individual bettor does create that advantage from shopping around, rather than just saying like, I'm going to go to this sports book, I'm going to beat this market. It's this weird playing field where if you can pick and choose and you have those opportunities and capital, you can create a more lasting advantage there.
Got it. And so speaking of different markets, because I wanted to bring this up, but I haven't, I guess, yet. So I brought up emerging markets. I'm sorry, U.S. markets, and how U.S. markets are very efficient. Mutual funds tend to underperform the market on average, probably better just to buy capitalization weighted ETF. In emerging markets, and especially China A shares in particular, which is, it used to be closed off. It's no longer closed off, but there's still quite a bit of inefficiency there. In emerging markets and China A shares in particular, there's a good chunk of inefficiency. And it seems like there's much more alpha to be earned there than there is in the US. So when I'm, telling folks, hey, look, in the US market, it's tough to earn alpha. It's tough to find alpha there. That doesn't apply to every market. I mean, it does probably apply to most developed markets, but in emerging markets, and especially China A shares, there's still a good chunk of alpha to be found. It's a little bit harder to trade those. You have to kind of work a little bit to open accounts in those countries. But, if one wanted to go on the alpha search and earn excess returns somewhere, it would probably be there as opposed to large cap US, certainly.
Yeah, that's really interesting to me, the emerging markets, but also in correlation to the second coming of cryptocurrency as well. I think that in the US, we're able to get a little bit of that, what you're talking about, the emerging aspect of these countries, or the alpha opportunities in countries. And we see that through the lens of cryptocurrencies, because those are essentially globally traded. They're things that are representative of the global economy, not just the US economy. And, a lot of the push in Bitcoin, I mean, I think like I saw some crazy statistic, like a huge percentage of all the Bitcoin is mined in China, right? And there's a lot of these international elements that are crossing over because of that. I would love your perspective just on that movement. On, I guess that's like a little bit different. It's currency trading, or as close to traditional currency trading as you
Right,
could think
right.
of.
Yeah. I mean, you can either view it as asset trading or currency trading, depending on, or I'm sorry, kind of like commodities-ish trading, in the sense that it doesn't, it's not clear what the expected return is, right? So when you think about commodities, you're not sure whether it's going to be positive or negative expected return, but there's likely predictability there. I think crypto, there's I don't trade crypto. And also I have no views on its long-term expected return. But it is almost certainly the case that there is alpha to be earned in shorter term prediction. And I say that with no empirical work on it. But the reason why I say that is because when something is traded so much by retail traders, and institutions have certainly gotten into it, but it's traded largely retail. It's traded 24 hours. So there are different markets trading it at different times. Then you will likely be able to find predictability there. So, insofar as one, we're thinking about where to apply ML algorithms over short horizons and build a kind of quant strategy, that seems like a viable place. Now, there are almost certainly thousands, maybe tens of thousands of people that have done that very thing. And I believe one of your first videos was a crypto algo, right?
Yeah, actually, about 2 years ago, I turned that into a product and then didn't do anything with it. And then now it's probably just useless code. But yeah, I wish I'd stuck with it.
Right on. Yeah. But I mean, I think that's what's kind of beautiful about the high frequency space is you don't necessarily need to have a view on the long term direction of the market. You just need to predict the next tick or next few minutes or whatever it happens to be. Now, and what's also good about that is it allows you to determine whether your model is good or bad quickly. So if you have a bet on something, a stock, crypto, whatever it happens to be, over the next 5 years, you're going to find out in 5 years whether you're right or not. And you might be lucky or unlucky. If you're trading over a tick horizon or a few minute horizon or a few hour horizon, you'll find out pretty quickly whether you're skilled or not. And that's good, right? It's good to learn that you're either good or not good at something and then just stop doing it or change the model or whatever it ends up being. And that opportunity isn't available at longer horizon prediction.
Yeah, I mean that's a really interesting point. Is that the shorter you get, the more data you have. The more data you have, the more relevant it is to machine learning. And so, I honestly never thought of that. That's really cool.
Yeah.
You can look at things by the minute, by the second, and that gives you significantly more data than what you had before. And you can look at. I think what I was doing, I was comparing the prices of different cryptocurrencies and the market using a recurrent neural net. And that was like a very, very basic approach. I mean, sentiment, I think, is more relevant now than it was before. But it's a cool problem to focus on and to understand.
Yeah, and now, I mean, I don't know if that algorithm was pre-transformers, but
it was definitely pre-transformers.
Okay, right. So that's another thing that's likely relevant to the prediction, or not relevant, but just would likely help prediction.
Awesome. And so the last area I'd really like to focus on is your kind of educational background. I think you went a pretty interesting route. So you have a master's in financial engineering and a PhD in finance. I'm interested in how those added value along your career, if they, again, also added value on the data front, and what you learned from those experiences, and essentially how they've again made an impact on your career, on your life, whatever brought
I don't want to say I regret doing any of those things, but they are they acted as pure signaling mechanisms. I didn't learn very much that was relevant to what I was doing because I was already in the job, right? So, and this is generally true, right? If you're doing a job, you're going to learn more about doing that job than going and getting a degree that's like somewhat related to the job. So I needed those things for signaling, right? Just to say, hey, look, I know something about this topic. And in particular, the PhD was because I needed, I was the head of research and am the head of research at this firm. And to not have a PhD as a head of research in a quant firm is just a little bit weird. So that was why I got a master's and a PhD. Did I learn anything useful? I learned interesting things. I don't think I learned anything that was like directly applicable to my work. Maybe one or two things, but it certainly wasn't. If that was all I was doing, if there was no degree at the end of it, and it was purely about learning, that was not a good use of my time at all. It was a horrible use of my time. Well, so yeah, go ahead.
So I think that's also a really important point. So working in finance or working in consulting, signaling is a lot more prevalent there. So if you have the PhD, but also what universities you went to, all these types of things. When I was trying to get into consulting the first time, I didn't get any looks because I did not go to a target school. And then I went to Virginia, which is a target school for most consulting firms, and I was able to break in, relatively well. It was difficult, but I still got in, right?
Yeah.
And I think that idea is that is one of the cultures of finance, consulting, and some of these industries is that if you want to break into those, like where you went to school or what degrees you have might matter a little bit more than, for example, even like Google or one of these tech companies. They're more focused on less on the signaling and more on what you've done or what you can do.
Yes.
And if you're looking to get into some form of quantitative finance, or you're looking to get into the data science consulting niche, you might have to think a little bit more carefully about the schools that you attend. If you're not, I really personally don't think it matters what school you attended. If you have a good GitHub portfolio, if you've graduated, like you're good to go.
Yeah. And if you have a good enough GitHub portfolio, that I think more than makes up for the school, right? If you've produced something that is obviously useful and compelling, that goes such a long way. But the issue is getting to the point where you can put it in front of someone. And that's it. It's somewhat astounding that a lot of what a degree is, and I know this is almost some like meme now, and I want to be somewhat thoughtful with what I'm saying here. I think that the education that's provided by these institutions is generally very valuable, certainly on the undergraduate level. So if you focus on things that are relevant to one's career at an undergraduate level, you will learn profoundly useful things. That being said, a lot of what is happening with degrees is going to someone and saying, trust me, I'm not an idiot, right? And you're expending a lot of effort to do that, right? You're spending years of one's life studying
to earn this I'm not an idiot certificate.
Right, exactly. Maybe we should start calling degrees that. I like that.
And the funny thing is, there are so many people that don't have degrees that they're obviously not idiots. They're doing far more advanced things than I'm doing, but there's this silly stigma for the most part because historically people haven't had a better way to evaluate talent. Now I think again, personal portfolios, projects, whatever it might be, are giving people alternative ways to showcase what they can do. But in more traditional industries, sports, finance, whatever that might be, people are still very hung up on these types of things.
Yeah, I think part of that might be there are a couple of things. One is being on the right tail of something. So if you're incredibly good at something, you don't need a degree to make sense of that. You don't need a degree to signal that. It's just abundantly obvious. So that's why we might see extremely successful people drop out of school. It's because it doesn't make sense to signal anyone. You know what you're going to accomplish, and you can just do it. And then the second place where you may not need to signal as much is where is fields where it's abundantly obvious that someone is skilled or not. I think web programming might be a place where it's clear very quickly whether somebody's good or not. So a degree really doesn't matter. If someone can sit down and achieve whatever thing they need to achieve with JavaScript and Python, it becomes very clear quickly, as opposed to investment management, where you have to wait a while to see whether somebody's portfolio is going to, So I think that those are the two aspects in my mind that are driving that. And so it's not at all irrational. It's just sad, right? It's something where people are spending a lot of money, a lot of time doing something that's probably unnecessary in the grand scheme of things, but is abundantly necessary to say, I'm at some level, and here's the evidence of that.
Well, I think it's a good parallel to the heuristic approach that you've described with investing, and the more quantitative approach going forward. Is this heuristic approach for a long time was the best thing that we had. Like, yes, seeing what degrees people had was historically the best way to determine if they might be a good data scientist. Like, yep, you know, if someone has a PhD, they've shown that they can dedicate their life to something for 3 to 5 years and work really hard on one problem. Mm-hmm. That's probably a pretty good skill for a data scientist to have. I mean, there are other things like working with a team and these other things that are really important, even more so now because there are teams. But if you're the only data scientist in an organization, 8 years ago, 10 years ago, the most important thing is that you can work on something for a long time, you can figure it out, and you're not scared of the ambiguity and all these types of things. So I think that, like what we're talking about with finance, like this getting into the field stuff will hopefully change over time as the broader technology fields evolve as well. One thing I do want to touch on before we're done here is, if someone did want to get into the quantitative finance field, how would you recommend that they go about doing that?
Yeah, I would recommend they go through the data science route instead of the finance route. Take some classes in finance, but right now I would much rather hire someone who knew a lot about machine learning and data than someone who just knew a lot about finance. And this is also true in terms of getting a PhD. So kind of all the way along the line from undergraduate to PhD, I would rather choose someone in the machine learning space, in the data science space, than in the finance space. And the reason why is the stuff within finance that is relevant can be taught in a fairly straightforward manner. Especially at the higher level with a finance PhD, that stuff is relevant to being a professor of finance, but not at all relevant to application. If you got a PhD in machine learning, you're probably going to learn quite a bit that is relevant to application, as well as becoming a professor or whatever it happens to be one day. So at every stage of the process, I would much rather hire someone in data science. So I would recommend, if you're going into quant investing in particular, and I think other firms increasingly feel this way, though it's not universal. You don't want to just study finance, and in fact, just take a class in investments, but focus on data science, focus on statistics. And as far as, what would kind of really be compelling, what would draw the attention of someone like me or anyone else who might be hiring, if you've got a project on GitHub, or just a personal project where you're predicting return using some data. I know it's actually very common for people to have projects like that, but it's still enough to demonstrate, hey, this person knows how to predict return, knows how to structure a model, knows how to scrape data from a website. All of those things are relevant.
Yeah, well, one thing I really want to add on to your project example, even though a lot of other people are doing it, like I always stress and encourage original projects.
Mm-hmm.
But if you really think about it, that project for the jobs you're applying for, that fit is incredibly good. And that can still be a differentiator for you. If, I'm applying to a finance position and I can clearly showcase what I've done in the past related to that same domain, that person is very likely going to click on it. If I'm applying to a big restaurant conglomerate and I have a project where I've identified what geographies would be great for a new restaurant, someone in that organization is going to read your project. Like it's relevant to the work. Even if you're seeing 20 of these, like you might learn something from these things.
Right.
Like
absolutely.
You can always pick something up. And so if you make it doesn't just have to be unique. If it's not unique but relevant to whoever's reading it, that's also very compelling. So
Yes.
I think that's good. That's also something I'm seeing. One of the reasons I went back, I did my master's in computer science rather than doing business analytics or one of these different programs, is I realized that I wanted to over-index in technology. I had some business intuition, but most people are looking for, a lot of computer science and some business. They don't want like a lot of business and some computer science as much, and they don't want all computer science. So I was like, look, if I'm going to do this, I want to go all the way in and really develop the technical skills heavily. And in the markets that I'm interested in, that's going to be more compelling.
Yes.
And so I'm going to echo what you say there, is just like, that also gives you a lot of power. Let's say you wanted to apply your data science skill set to other industries. It's going to make it easier to get jobs that aren't even necessarily data science. People want those technical skills. And if you show interest, if you're like engaged in that domain, there's a lot of opportunities present there.
Yeah, and in general, I think picking up technical skills plus writing maybe would be the other thing, is the most important thing that one could pick up in school. As far as business intuition and so on, I'm not even sure one can learn that in school very well. That's something you just want to learn on the job and figure that stuff out in the field, because it will be so domain specific.
That's a really good point. I think what you can learn is domain knowledge as well as technical skills, but the softer skills, I mean, you can learn some of the softer skills in school through internships, through working in group projects, through clubs, whatever that might be, but it's a lot harder to showcase that. I mean, you should focus on the things that you have are like as tangible as possible to showcase in your GitHub and your resume. So honestly, those are all the questions I had. Are there any things that you want to share, any parting words of advice, any causes you care about, whatever that might be?
No, I think this was a fantastic conversation. I appreciate the opportunity to talk to you.
Awesome. And where can the listeners learn more about you, on LinkedIn, Twitter, or what's the best place?
Yeah, just toss my LinkedIn in the show notes, maybe.
Will do. Absolutely. So again, thank you so much for coming on the show. I greatly enjoyed this. I learned quite a bit today. So if I learned something, hopefully everyone else will as well.
Well, wonderful. Great talking with you.